Hello, we are from Group 4. Today we will represent the topic 3. Our presentation includes 4 parts. The first part is about the basic law of demand. The second part tries to explain how speculation changed people's consciousness about their demand. After that, the third performance will attempt to explain how interest rates work in the short run in relative to law of demand, but not as it should be in the long run. Finally, we want to expand our view about the situation to social responsibility, especially about how immorality can encourage people buy high that does not match basic law of demand, creating crisis in the financial market.
The law of demand is that when other conditions remain unchanged, the price will rise and the demand will decrease. If the price is regarded as the cost, the law of demand means that when people get the cost of an item, the demand for the item will decrease. On the surface, this sentence seems to be correct. As a rational, selfish person, when the cost of paying increased, it will obviously reduce the demand for the item. However, this understanding only analyzes the cost and does not analyze the benefits. Cost and benefits are never calculated separately. Logically, people are willing to pay some price because they want to get some benefits. Therefore, just analyze the cost and neglecting the income to analyze the demand behavior of the person is inevitably biases. From the perspective of cost and benefits, when the cost of getting an item increased, even if the income does not change, people will not reduce their willingness to demand an item as long as there is a return. Although the income is reduced, there are still gains, and people's demand will not decrease. Therefore, the correct expression of the law of demand is that when the costs rise more than the income, people's need will decrease. It can be seen that only analyzing the changes in costs will not know the changes in people's supply and demand behavior. Therefore, it cannot be said one-sided that cost determines supplies and demand, but cost and benefits jointly determine supply and demand. But the income is the expectation of the future. It is uncertain, and only the cost or price changes. It is impossible to know what will happen to supply and demand behavior.
In the sharp rise in the price of an asset, the initial price increase causes expectation that price will rise further, thereby attracting new buyers. These are generally profit-seeking speculators. Speculation refers to the trading behavior in which the profit is taken from the market based on the judgment of the market, taking advantage of the market price difference. It is different from investing in the degree of risk and different from gambling in the randomness. If you buy a building and live by yourself, the income is certain. If we are investing, the income depends on the future price change. If we expect future price to rise, even if the current price rises, the demand for people to invest in buildings will increase because the expected increase in future earnings is greater than the increase in cost, which is speculation. This kind of speculation creates speculative demand, and speculative demand has nothing to do with change in current price depending on people's expectation of future price change, in which case the demand law is clearly untenable. We can also find speculation in bond market. When the current interest rate is declining, people expect interest rate to continue to fall. Then they will abandon the currency and hold the bonds. That is, it reduces the demand for money, so that not only can higher bond yields be obtained, but also when the interest rate falls later, it will get extra income for the appreciation of the bonds. Conversely, when the current interest rate is increasing, people expect the interest rate to continue to rise and then abandon the bond and hold the currency. That is, increase the demand for money so that the loss of income and risk can be minimized. It can be concluded that the demand law does not apply in speculative market.
In this part, I want to focus on first how interest rate function works according to the law of demand and how credit system creates cycle as well as how it makes the law of demand work in another way. In particular, when central bank and governments want the economy to grow, they will lower the interest rate in order to make credit more available to borrowers, including individuals and businesses. For example, if a business wants to pick up their productivity in the short run, they can borrow money from the banks to expand the manufacturing plant. In the level of the economy, the more credit, the more spending, leading to the more GDP growth. That is expansion phase that we see on the slide. After that, when economic activities picks up to a level that inflation is very high that can cause some problems to the whole economy, central bank will increase interest rate to diminish the economic activities again, decrease the GDP again, beginning the recession phase. It is exactly how the law of demand works in the short run. However, the human nature is different. It's about expectation. According to Ray Dalio, written in his book Principle in 2017, people always want to expect about good future. They think that things will happen in a good way in the future, causing credit grow faster than income, push the economy up in the long run. Naturally, individuals and businesses continue to leverage their access to borrow more money than invest in the bullish market to make more profits. In the short term, it makes economic activities grow very quickly despite of interest rate increasing. Because the return rate is larger than interest rate, it pushes the asset value goes up, increase the stock market value, and so on. With more asset value as collaterals, people and business can borrow more and spend more. This process happened again and again in many years, creating the bubble. For example, as you see on the slide, from 2004 to 2008, American debt burden increased while interest rates still hike. It is the signal of the bubble. As a result, in the 2008 as well, the bubble crashed, causing the financial crisis. That's a disadvantage of the developing very quickly of the economy.
Okay, my part will introduce the immortalities. My part will divide into two parts. The first part will introduce the Hong Kong financial crisis. A second part will introduce the real estate industry. Some institutions and fund managers sell bad bond and fund to investors. These bad bond and funds are often considered to be the lowest level by rating agency, which means that these wealth management products are very risky and cannot be used for real investment. Due to information asymmetry, investors often easily believe in the fund management's recommendations, resulting in the final loss. For example, in the late 20th century, before the financial crisis in Hong Kong, many fund managers were still bragging about their wealth investment products, although they knew it was a trap. In second, I will introduce the real estate industry. In the real estate industry, in order to maximize profits, many small and medium-sized banks in the United States rapidly issue home loans to customers, resulting in false high real estate price. At the same time, small and medium banks will then sell their bad bonds to big banks. And the big banks will not hesitate to buy this bad loan in order to expand their business scope and performance. It is this unethical business practice that led to outbreak of the global financial crisis of 2007. Institution and fund manager for this interest and the result of performance ethics. Selling bad financial products to customers resulting in customer benefits. Small and medium-sized banks are free to issue home loans for their interest, cause the real estate industry to derive from normal operations. Large banks and blindly pursue performance and illegally acquire their acquire these non-performing loans. This unethical behavior can easily lead to economic crisis. Okay.
Thank you for listening to our presentation of topic 3.